All right. Well, welcome to another exciting training on venture capital due diligence. This is sadly our last workshop before you're all going to submit your final analyses as part of the competition. Hopefully the last several sessions have been interesting, helpful, educational, and hopefully this one is as well. So today we're going to wrap up the remainder of due diligence training. We are going to cover specifically, it's not in here, but the first thing is actually the offering. We're going to talk about how to assess management teams. We're going to talk about financials and projections, returns. We're going to talk a little bit about crafting your investment deck, like all the things that you should have in there. And then we'll review deadlines and deliverables. And then I'll hang out for a little bit if any of you have questions and want to chat about those. So let's dive in. So just a reminder that the deliverables for this include a 10 to 15 slide presentation that covers the following things. So the first one is the offering. We're going to talk about that, what that means. Then it should include a description of the business and the strategy of the business. What do they do? How do they make money? How do they create competitive advantages, etc. You'll include a management team analysis and an evaluation analysis of the market and the competitive landscape. You'll look at historical and financial projections, so historical financials as well as forecast. You'll have an exit strategy where you talk about how you're going to get your money out of the company once they're successful, and then what your projected returns are for that investment, and then wrap it all up with an investment thesis that is basically a summary of all the prior things. You will have 10 to 12 minutes to present, followed by 8 to 10 minutes of Q&A. In total, every presentation should be about 20 minutes long. Including Q&A. So just keep that in mind. You'll have roughly a minute per slide to present it. So we got to move through it fast, because otherwise we'll be there all day. But that doesn't mean that you shouldn't have good, robust, detailed analysis in your presentation. All right. So let's talk about the offering. So the offering is, what is the company offering to investors as an investment opportunity? Now, in general, there are 3 types of investments. Really, it kind of boils down to just 2, debt or equity. In the case of venture capital, I threw in this third one, which is convertible debt, because it sits in between. Convertible debt is a security that starts out as debt, but hopefully eventually becomes equity. And if you think about venture capital, the majority of what we do is either in equity or in convertible debt. We're never really investing in pure debt. And so I think it's helpful and useful to understand convertible debt. So that's why we've included it. It could very well be that a lot of the companies you are looking at are currently raising convertible debt rounds. So let's talk about each one of these individually. So the first one is equity. Now, when it comes to valuation, people throw around these terms pre-money and post-money. And it's actually pretty straightforward. The pre-money is what the company is worth today without any investment. So if your company is worth $10 million, that would be your pre-money valuation. Now, your post-money is the valuation after you've received an investment. So if your company's worth $10 million and you raised $2 million, the logic is, I just gave you $2 million of value, right? You're going to put that cash on your balance sheet, and hopefully you didn't like just take that money and burn it immediately. It's actually like sitting there and creating value or has value, and just added $2 million of value to your business, right? And that's how you get to this post money. Once you raise that money, the post money now is the valuation of the business going forward. And investors are investing in that company because they believe that the company has the ability to take that $2 million and turn it into a multiple of $2 million of value in the future, right? So over time, as the company uses that money and invests it in things like sales and marketing and product development and so on and so forth, that should yield a higher return or a higher valuation than what that money was worth originally. But the minute it's invested, it hasn't done any of those things, and so it's just cash on the balance sheet, right? It's just that value. So that's pre and post money. In general, if I invest $2 million into a company that's valued at $10 million pre, then I could divide that $2 million by $12 million, and that would get me my ownership percentage of the company. In that case, it would probably be roughly around 16%. So that's how you would calculate your ownership. Now, equity in venture capital typically is done as preferred shares. So there are two basic types of equity. You've got common shares and you've got preferred shares. Now, if you spend any time looking in the public markets, you're probably somewhat familiar with preferred shares. And in the public markets, preferred shares actually tend to act a little bit more like debt. You have a dividend, but it's like a guaranteed dividend that's like similar to an interest rate. And it trades different. I mean, it's got a lot of things that make it a lot more like debt. That is not the case really with venture capital preferred equity. In some cases, it may have a dividend but tied to it. But the reality is, like, those dividends never really get played or used. But the reason why venture capitalists will invest in preferred rounds is in preferred shares is primarily for two big things. One, preferred shares, basically, you've got common shares, and common is what it is, right? It's like everybody is common. They all get the same rights, the same privileges, the same stock. Like, it's just common, right? But with preferred, you basically are able to put in place different terms and provisions that give you additional rights. So those rights could be things like the preferred shareholders get a board seat, even if they don't own enough percentage of the company to otherwise warrant a board seat. So you may come in and own 10% of the company and get a board seat on a board of only 3 people, in which case you're effectively getting the vote of 30% of the stock. It could also come with certain rights around making decisions at the company. So they may have the right to say, you can't spend any more than a certain amount, or you can't sell the company without our permission, or you can't hire somebody without our permission, right? So there are different rights could be included. But the key thing is that preferred shares allow you to attach these different rights and privileges to the stock. So that's the one reason. The other reason is that it provides downside protection, because preferred shares are set higher in the preference stack. In other words, they get paid back before common shares are paid. And one of the rights that is oftentimes used to establish this is what's called a liquidation preference. Now, a liquidation preference is a term that's put in there that provides downside protection in the event that a company gets acquired or files bankruptcy or what have you. And basically what it says is that the investors that own the preferred shares will get paid back their investment before anything is shared with common shareholders. So if we take my example of the $10 million plus the $10 million pre-money plus the $2 million investment, let's say the company ends up getting acquired for $10 million. Well, that's actually a drop in valuation because our post money was $12 million, right? So in that case, if a company gets acquired for $10 million and investors own roughly 16% of the business, they're going to get $1.6 million back instead of $2 million back. And in other words, they would have a loss, right? But if they have a liquidation preference through the preferred shares, they would get their full $2 million back. And then the common shares would split up the remaining $8 million. So it provides some downside protection. Now, this could get even more extreme. Let's say the company gets acquired for $2 million. The investors in that case would be able to get their full $2 million back, and there would be zero left for common shareholders. So it provides some downside protection for the investors. Typically though, what happens is as a preferred shareholder, you have the right to convert to common. And this is important because usually liquidation preferences are capped at the amount that you put into the company. So if I put $2 million in, that's the most I could get back. Unless I convert to common. If I convert to common, then I get my ownership percentage of the company. So if the company gets acquired for more than $12 million, then it's in your best interest to convert to common and get your 16%, right? I mean, if they get acquired for $20 million, now we're talking about pulling out $3.2 million, right? If you own 16%, that's going to be $3.2 million. That's higher than the $2 million you put in. So you would want to have that instead of just getting your $2 million back. So that's how liquidation preferences work. The key thing is to look through and understand what kind of stock are you buying? Are you buying common stock? Are you buying preferred stock? And if you're buying preferred stock, does it come with some sort of liquidation preference? Now, I'll tell you right now, if you're investing in a company on WeFund or Republic or Start Engine or one of those, you're probably not investing in preferred shares. You're probably investing in common stock, which is not going to provide a liquidation preference. And so you'll want to flag that, what type of security you're investing in. Now, as I said earlier, like equity does not include interest. It's not debt. Sometimes it will include dividends, but for the sake of this competition, don't worry about dividends. There might be other provisions like stock buybacks, board seats, et cetera, et cetera. If those show up, or pro rata rights is a really big one. Pro rata rights basically give you the right to continue to invest in the company to maintain your ownership percentage and to avoid dilution over time. So that's what pro rata rights are. If you're investing in preferred stock and you know what the terms are generally, if you're going to have a liquidation preference, pro rata rights, et cetera, then those are worth flagging when you're talking about the offering. You'll definitely also want to hit on the pre-money valuation, how much you're investing, and how much everybody else is investing, and then the associated post-money valuation as well. All right, so that's equity. Let's skip over convertible debt and let's talk about debt for a minute. Now, debt at its core is really like you are renting money to somebody else, is kind of the way to think about it. So instead of renting like an apartment, you're renting money. And the rent that you pay on that money for the privilege of using it is your interest, right? So if you live in an apartment, you benefit from living in the apartment, you pay rent. For loans, you're taking that money, you're using that money, and in exchange for using that money, you pay, instead of rent, you pay interest. But that's really what it is if you think about it at the end of the day. And but at the, you don't actually own the apartment. When you're done using it, you give it back, right? And you don't get your rent back. You paid for that usage. And it's the same thing with capital, with debt. You take that money in, you use it for whatever you need to, and when you're done using it, you give it back, plus you pay interest for the opportunity to use it. Now, because you don't own the money and you need to give it back, if the company gets acquired or goes public or files bankruptcy or whatever, the people that own that money have a right to it, right? And this is the whole concept of what's called like a first lien, where debt holders get paid back first before equity holders do. Because in a real way, the equity holders are just borrowing this money from somebody else, and they eventually need to give it back. It's not theirs, right? And so legally, debt holders get paid back first before equity holders do. There is no real valuation on debt because there's no valuation, right? They're not owning a piece of the company, debt providers, right? They're just lending some money out. And then you've got some other terms that could be important, like the term of the loan. So how long is the loan, or how does it get paid back? In both like venture, but also just business generally, you have lots of different types of loans. You have loans where you make just interest payments on a monthly basis, or on a quarterly basis, or on an annual basis. You could borrow the money for a year, 5 years, 10 years, right? It might also be the kind of thing where you're paying both the principal and interest at the same time, like a mortgage. But it also could be something like a balloon payment where you pay nothing. You get the money and you don't pay anything for 3 years. And then at the end of 3 years, you pay all of the money back plus all of the interest. So there could be a lot of different types of loans that are used. You could have loans where, it's like working capital and you have to pay it off every quarter, right? Only the term of the loan is only 3 months. So, in this case, you're not really going to be investing in debt, but it's important to understand like what debt is and all the various ways in which it's used. Because let's talk about convertible debt. So convertible debt is the type of debt that VCs will invest in. And the reason for that is because as VCs, I don't want just interest. Interest is not enough. I want ownership in a company because that's how you generate the biggest returns, is you own a piece of this thing as it gets bigger and bigger and bigger. But sometimes it's really hard to know what the valuation of the company should be, right? If you're a handful of people in a garage working on something, but you don't even have a customer yet, what is that worth? If it's Google, it could potentially be worth a lot, but the problem is you don't know if it's going to be the next Google, right? It could be one of the millions of other startups that failed and never became a Google. So putting a valuation on it can be really challenging. And so what happens is, and the other thing too, is that convertible notes tend to be a lot cheaper from a legal perspective because it's just a pretty standard document that says, hey, yeah, we're going to borrow this money and here are the terms to borrow the money. Whereas with equity, especially preferred equity, it's a lot more of like, oh, well, this is what happens in this scenario and this and this and this. And like you have very complex legal structures to handle equity, particularly preferred shares. So in convertible debt, oftentimes startups, especially smaller ones, young ones, will use convertible debt as a way to raise money quickly and cost effectively, and to also kick the can down the road when it comes to valuation. Now, investors, though, are savvy in that they don't want to totally kick the can down the road on valuation, because what happens if you don't take evaluation into consideration, you could massively overpay for a business relative to the risk. So a valuation cap, the way it works is if I invest in a convertible note, I'm hoping that at some future date, my debt investment will convert into equity. And the way that these are typically structured is that it will convert at the valuation of the next funding round, the next equity round, minus some discount and taking into consideration some cap. But ultimately what you want is you want that debt investment you made to convert into equity at a future round, and you want it to convert at a valuation that reflects the risk that you took on. And so that's where discounts and valuation caps come into play. A valuation cap will say, when we convert into equity, it can't be higher than, let's say, $10 million or whatever that valuation cap is. And that protects you as the early stage investor, because what if you invest in the next Google, but you do this with your convertible note and you don't have a cap? Then what could easily happen is Google's next round, right? You gave them all this money. That gave them the ability to build the product, finish it, get a bunch of customers. They then go and raise that next round. It's substantially de-risked. Venture capitalists get all excited about it and they give them $100 million valuation. Well, in that scenario, your investment would convert in at $100 million valuation. And you will have taken all of this risk by investing much earlier, but you wouldn't get compensated for it, right? So that's why investors will put in valuation caps, and they'll say, okay, look, we don't know what you're really worth. You could be worth zero, but you could also be worth maybe $100 million. Why don't we invest in a convertible note? And then what we'll do is we'll put a valuation cap on it of like a $10 million valuation cap. That way, if the money that we give you helps you become wildly successful, and the next round you're valued at $100 million, then we'll cap out at a $10 million valuation and we'll get rewarded for all of that risk that we took. So that's kind of the benefits of using a valuation cap. Now, you also have what's called a conversion discount. And oftentimes these are used in parallel. Occasionally they're used individually, one without the other. But in general, they're used together. Now, conversion discount basically gives you a discount when it's time to convert. So those discounts could range anywhere from like 10 to 20 to 30 to 40 to 50%. So in that case, let's say the company didn't raise at a $10 million valuation, they raise, or $100 million valuation, or even a 10, but they raise at a $5 million valuation. And I have a 20% discount to that. Well, in that case, maybe the company wasn't as wildly successful as being worth 100 million, but it is still some level of success. You still don't want to be paying the same price as those people that came in at that point. So you would pay the discount. So if it's a 20% discount and they raise it a $5 million valuation, then your investment would convert at $4 million valuation. And it would be as though you had invested at a $4 million valuation instead of a $5 million valuation. And that's how they provide some of this, this downside protection, not even so much downside protection as much as it is reward for coming in early and taking on more risk. Now, the two other things is, remember, this is convertible debt. It's debt. So it's like pure debt, in that it's also going to have some downside protection provisions. And that is that until your investment converts into equity, the company is technically borrowing the money from you. And so you have a first lien position. You get paid back first before equity holders, which is important. Now, usually you're going to get paid back after non-convertible debt, but you still will get paid back before equity. Now, the other thing is that oftentimes, the person that's borrowing this money from you typically is going to pay rent on that equity in the form of interest. But in this case, it doesn't really make sense to give a startup a bunch of money and then pay that money back in interest. I mean, really, they need every penny they can get to grow the business or finish their products or what have you. And so you have what's called PIK interest, which stands for paid in kind. And what that basically means is that instead of paying you cash, they're just going to add more to the debt. And when it converts, it's going to convert into equity. So if, let's say, you make a $100,000 investment in a convertible note with a 10% interest rate, 10% PIK interest rate, then after 1 year, that's going to be an extra 10% or $10,000 of ownership, of money that you have effectively loaned the company. And then if they convert your original investment into equity, it's going to be your original $100,000 plus an additional $10,000 of this PIK interest. And so combined, you'll get $110,000 worth of equity instead of just $100,000. Now, under convertible notes, there's also a thing called a SAFE. SAFE stands for a simple agreement for future equity and was developed by Y Combinator to make it even easier and more cost-effective for small companies to raise money, and has quickly become like the preferred way of raising convertible debt like capital. Now, safes are not truly convertible debt. They're not really equity. They're more like a contract, but they're gonna, for all intents and purposes, they act very much like convertible debt. So you'll almost always have a valuation cap, you'll have a discount, you'll get paid back first in the event that the company goes bankrupt or gets acquired or what have you. But they typically don't have an interest rate because it's not technically debt, it's more like a contract. It's a simple agreement for future equity, and is supposed to be is designed to better reflect equity, the kind of this mix of equity and debt. So I will pause there. Any questions on any of that? It's kind of a lot. Great. I'm glad that you are all experts in securities. Now, key things you need to take away from this. If you're investing in equity, make sure you're covering your pre-money, your post-money, any terms that are relevant, like liquidation preference, pro rata rights, etc. How much you're investing, how much the total round is for. If you're investing in a convertible note, make sure you hit on what's the valuation cap, what's the conversion discount, is there an interest rate, is it a convertible note or is it a safe? And be able to answer kind of those questions related to that. Okay, let's move on. So let's talk a little bit about management teams. Now, there's a big debate. What do you guys think? You can voice it out loud or throw it in the chat. What matters more in startup land? Is it the horse? Is it the company, the market, or is it the jockey? What do you think?
The jockey.
Okay, why the jockey, Brendan?
I just feel like, specifically in regards to startup companies, the founders are everything. I mean, it's their dream, their vision, and they're the ones ultimately driving it. And so ultimately, I would say the success of it is based on their ability to run the company.
Yeah. Okay. Isaac says the horse. Isaac, why do you think it's the horse?
I mean, there's not really a race without the horse. I think they're both important, but if the horse is bad, it doesn't matter how good the jockey is if it can't keep up with the other horses.
Okay, that's fair. I mean, ideally, you're investing in an A+ team, an A+ jockey that's creating an A+ company, right? But that's not always the case. There's an investor, he actually passed away a number of years ago, but he's like one of the godfathers of Silicon Valley, Don Valentine. And Don Valentine was the founder of Sequoia. And there's a presentation, you can find it, where he talks about markets and startups and so forth. And he makes a very strong argument that it's not about the jockey, it's about the market. That's what matters most. And that Sequoia is really good at finding like where the puck is going kind of thing, like where the next big market opportunity is. And that's how they make investments. They say, okay, here's what where the market's going. Let's go find the very best team doing something in that market. So, it's a little bit of both, right? Both are important, the market and the horse. Or the market and the business and the people running it. I'll give you another example. So we're an investor in a company called Instructure, and it was interesting because on the one hand, I don't like Instructure makes Canvas. And when they launched, the other solutions, the other learning management solutions out there were so terrible that everybody was just dying for something better like Canvas. And I know like several people that were in sales there that probably weren't even all that impressive, but like it was like shooting fish in a barrel. Like it was just so easy because people are so desperate. And this gets back to what I talked about last time, which is really understanding pain points. If you understand the pain point at a really deep level, and you're able to, like, as a company, identify a pain point, or as an investor, invest in a company that is solving a huge pain point, it almost doesn't matter who the management team is, because people are going to like fight tooth and nail to get that problem solved for themselves, right? And so companies can perform and do really well. Speaking out of the other side of my mouth, though, with Instructure, is that they really struggled. They were kind of in, the wilderness for a number of years. They hired a CEO. He was kind of okay, but not great. And the company just kind of languished. And it wasn't until Josh Coates came in and took over the business that all of a sudden it immediately started to flourish. He was like, he had been there, done that. He was confident. He knew what needed to be done. He had the clout to go and hire some incredible people to help him do it. And there was like this big pivot from like mediocre company to an amazing company, one of the best that's ever been created, built in Utah, in a relatively short time period after he joined the company. So point being, both are equally important. But your A+ team is ultimately going to find and build A+ products and companies. And so that's generally, in my opinion, why most of the time people focus on the jockey and say team, team is the most important thing, team, when evaluating startups. So how do you assess your team on the companies you're evaluating? So there are like a lot of different ways to do this. We could spend like a whole semester talking about how to assess people and psychology and all those other things. That said, let me give you some general guidelines. So one is, given the industry and the key risks, do they have the right people? If you are operating in a highly regulated industry, you probably want to have some people that understand regulation really well, right? If you're operating in a consumer products or a consumer tech space, you probably want people to understand that. I was talking to this guy, very experienced investor, and he made the comment, he was like, look, I don't invest in people, in consumer tech companies that are led by repeat founders, or anyone over the age of 30. He's like, for those businesses, you really need like the next, big thing to come from somebody that's younger, that can see the future, and in a way that like older people aren't able to, right? So think about like Facebook, even companies like Google, which are really consumer facing, were started by people in their 20s. He's like, on the other hand, I will never invest in a software business that's started by somebody under the age of 30, especially in the enterprise space, because they don't know what they're doing. They don't have enough experience yet to fully understand the pain point. He's like, I love investing in entrepreneurs that are on their third startup, and the prior two look exactly like this one, same industry, software, selling to a similar client, et cetera, because those are almost like risk-free. So understanding, like, do they have the right people for that industry, for those key risks, to help them navigate it and outperform. The next thing that I like to bring up is, are they the right size? Do they have the right size people, the right number of people, given the size of the company? So sometimes, I mean, there's actually kind of a joke in the industry that the number one killer of startups is premature scaling. And what they're saying there is that like companies think that they've figured out the business model and they're solving this big pain point, But in reality, they still have a lot to figure out. But because they think that they have it all figured out, they start hiring a ton of people. They start scaling the business too quickly, premature scaling. And when they do that, they start spending a ton of money, and pretty soon they burn through all the money, and they're not generating enough generating enough revenue, and ultimately the business ends up collapsing because of it. So be wary of companies that have too many people that are spending too much money before they've achieved true product market fit. And product market fit is basically at that point at which a company can start scaling very quickly, because essentially they are solving this massive pain point for customers. Now, the last one is team market fit. Now, team market fit, I think about in terms of, do the entrepreneurs really understand their market really well? Have they, or another way to think about this is this concept of like an earned secret. So I think we talked about Airbnb last time. This is that same general idea, like what experiences or what price have they paid that has given them some unique insight into the market, and what talents and abilities do they have that allow them to really resonate with that market and their customer? Do they have team market fit? And in an ideal world, right, you would look for people, if you're doing enterprise software, you look for people that have built enterprise software before, been there, done that, sold it, raised money for it, et cetera, et cetera. If you're in a services business, you're looking for people that understand services and how to build services businesses. If you're doing consumer products or consumer tech, you're looking for something similar, right? People that have experience or they have unique insights that other people don't have. So look for those types of things. Another thing that you can do, now this one's a little bit tricky, because if you're looking at super early stage companies, they may not have this data, right? They may not be big enough, they may not have reviews, but Glassdoor is an incredible resource when it comes to evaluating management teams and finding things. So my advice is, if the company you're evaluating has enough there to actually dig into the Glassdoor reviews, read all the reviews, as many as you can, the good and the bad. Look for information regarding the management of the company, the direction of the company, the culture of the company, and look for signs of high turnover. If there are a lot of people leaving the company because they're disgruntled, they're unhappy, that's a huge risk, especially if maybe it doesn't even show up in Glassdoor. Maybe you see it on places like LinkedIn, like a co-founder left. That could be a red flag of some serious issues that you would want to dig in more to really understand. Because turnover at the end of the day is just super expensive. If you think about how long it takes to find somebody, get them trained up, get them actually producing value, if you then lose them 6 months later, that can be a massive hit to a business and hard for really, really small companies to fully recover from. So watch out for that. The other thing too to watch out for in these reviews is anything related to like fraud. If there are indications that the CEO is dishonest and saying fraudulent things, you should run away as quickly as possible, because that will only end in massive issues for you. Okay, so that's management. Another thing that you should also look for is if you have access to LexisNexis, you can do some basic background checks on people. You might be surprised how often people have gotten tripped up with the law that could cause you problems. For example, in some cases, the SEC can come in and say that this person, violated some law and can no longer be an officer of a publicly traded company. That means that you either got to get rid of that person before they go public, or the company can't go public. And so you want to be aware of those types of things. There have been deals where we found that the CEO was convicted of all kinds of crazy things in the past and tried to sweep it under the rug. And we passed on those investments for those reasons. So worth doing your diligence into their backgrounds. Okay, moving right along, let's talk a little bit about financials. Now, for the sake of this competition, we're not asking you to do extremely detailed, deep financial modeling. The companies you're looking at probably are so small and don't have a ton of traction that deep financial modeling is not actually like super helpful, and probably in most cases would be counterproductive. That said, you do need to understand kind of like the basics, particularly an income statement and unit economics. So that's what we're going to cover in this training. Now, an income statement, for those of you that aren't finance majors, is basically like a description of how the business model works. So you've got revenue at the top. That's like, if I sell a widget, that's how much I get for that widget. Then I'm going to have cost of goods. That's how much it costs me to produce that widget to sell it. The difference between those is going to be my gross profit. Now that's, the difference. Like if I sell the widget for $100 and it costs me $25 to make that widget, then I've made a gross profit of $75. That's what I have left to cover all the other expenses in my business, right? So if it costs me money to go out and meet with customers and convince them to buy my widget for $100, then there might be some sales expense related to that. If I got to go and put up a billboard so that people even know my product exists, that might be a marketing expense, and I got to cover that. If I've got office space, if I've got retail space, right? I need to cover those expenses. All those things sit under operating expenses and have to be covered by what's left in your gross profit. Once you subtract out all your operating expenses, you're left with what's called EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. EBITDA really is a metric that tries to get at the output of the engine that you've built as a business, the cash generation. And the reason why you don't include interest, depreciation, and taxes is because a lot of businesses will do a lot of different things when it comes to how they're structuring their taxes or how they are financing their equipment or what have you. And it doesn't really pertain to the actual economic engine that's being used to create cash. And so oftentimes you'll take it out, and it allows you to compare one business against another from its like cash generation potential. Interest is like if you have any loans that you've borrowed money for, that's what you're paying in terms of interest on those loans. Depreciation refers to the assets that you've bought along the way. So let's say you buy some machinery to make these widgets. Well, in a tax-friendly environment, you'd want to depreciate, you'd want to write off the entire expense of that machinery the day you buy it. But the IRS is like, but that's, you didn't really use up the machinery immediately, right? You could take that, you could take a deduction or write off an expense when you pay somebody for their sales efforts, right? Or you pay for that billboard because you've used, you spent the money and that marketing exposure was put out there and now it's used up and done. Like that makes sense to expense that. But when it comes to plant, property, and equipment, you're going to continually use that property over time. And you're going to slowly use up the machinery over time. And so you have to expense it slowly over time as it gets used up. And that's what depreciation really is all about. It's trying to capture the usage of the machinery and other assets over time. Even though it's technically a non-cash expense because the cash went out the door when you bought the machinery. And for depreciation, you're basically saying, okay, well, I'm going to write off or expense a percentage of that cash that I already paid. That allows you to reduce your tax burden. And then that once you subtract out interest, depreciation, and taxes, that leaves you with your net income and your associated profit margin. Now, net income should technically be money that you can take out of the business and put in your pocket as an equity owner. That's not always the case because it may not be a pure cash related amount, but in the long run, it does represent the money that is possible to pull out of the business and put in your pocket. So those are your profits, net income. Any question on income statements and what they are, how they work? Okay. So once you understand your income statement, you can start thinking about like, what has it been historically? How much revenue have they generated and how much have they spent to generate that revenue? And then you can take that information, you can start forecasting it forward and saying, well, if they spent $20 to generate $100 in revenue, and next year they plan on spending $40 in marketing expense, then it's reasonable to assume that they will hopefully be able to generate $200 of revenue, assuming that their market efficiency doesn't go down, right? It's also like hopeful that your gross margin stays about the same, that it continues to only cost you $25 to produce $100 worth of product that you sold. There might be arguments, though, that as the company gets bigger and bigger, you're able to drive down the cost to manufacture your widgets, and so your gross margins could improve over time. The corollary to that, though, is that as you get bigger, other people may enter the market and say, hey, we can sell these same widgets too. And then in that case, the amount that you're able to charge for those widgets could go down. So you've got downward pricing pressure on you. And even though you're getting better economies of scale and your cost of goods sold is going down, your gross margin could still go down if the price you're able to charge for that product starts declining. So these are all things to take into consideration as you're trying to forecast things going forward. The other thing, though, let's see. So talking about historicals then is when you're analyzing their financials, right? If they send you over financials, the thing that I like to think about is like, what have they figured out versus what have they proven? So sometimes like a company will figure out like, hey, there's an opportunity to to like do marketing on Facebook, and they'll start spending there. But they haven't spent enough money or enough time yet to really prove that that is a viable marketing outlet for them. So, but if you look at their financials and they have very steady performance on marketing to revenue spend over time, then you can kind of make an argument that they've proven that out. And once they've proven that, then it gives you a lot more confidence to say, okay, going forward, revenue will be a percentage of marketing dollars spent, right? Because marketing and sales will ultimately be driving top line revenue. And there could be other factors that are drivers, but most often they're going to be related to sales and marketing in one way or another. Another thing that you want to look at, are they growing quarter over quarter, year over year? Generally, at this stage, the company should be growing at 100% plus year over year in terms of revenue. And it's not uncommon to see businesses that are growing by 1,000% year over year at the earliest stages because they're just so small. I mean, it's easy to go from $1 revenue to 100,000 in revenue. It's a lot easier to go from that, 100,000x than it is to go from $100,000 to $200,000, right? Which is only 2x growth. So that's why you want to look for pretty high growth in these businesses. The other thing is, it's really helpful to understand the unit economics of the business and the key drivers of the business. So like I said, key drivers could be like marketing spend, number of sales reps, partners that you have, users on the platform, and conversion rates. Could be number of transactions. Could be a lot of things. If you're looking at a fintech business, maybe the things that you care about are like the number of transactions that they're getting, because every time somebody swipes a card for that fintech, they're going to take a cut of that transaction. On the other hand, it may be that like marketing spend and sales reps, spend on sales reps is more important if you're selling like an enterprise software product where you need marketing dollars to get leads, like get people interested in what you're doing, and you need sales reps to actually close the deals. So it really just depends, it varies, on your businesses to identify what are those key drivers, but really thinking critically about what are the activities that a company does that ultimately result in revenue. And then as you're forecasting it forward, like, does the growth rate make sense? Companies usually grow at declining growth rates, which is what I was talking about earlier, right? It's easier to go from $1 to $100,000 in revenue than it is to go from $100,000 to $200,000 in revenue. To go from $1 to 100,000 than it is to go from 100,000 to $1 billion, even though both roughly represent the same growth rate, right? So oftentimes what happens is companies will decline in growth rate, but it's not uncommon for startups to come to you and say that they're going to have accelerating growth rates. And so you should always be wary of projection models that look like that. All right, so let's talk a little bit about unit economics, just because I think this is helpful, particularly the stage of companies that you're looking at. If you can get unit economic data, then it's like gold. It's super valuable because you're able to understand if a company will be successful and valuable over time. A good example of this is like sometimes you look at businesses that are losing money. And they're losing a lot of money. Like a lot of enterprise software companies lose a lot of money. And if you look at it just on its face and say, geez, like these companies are burning a lot of money, like they're massively unprofitable, the losses keep growing year after year, you might think that it's a bad business and you don't want to invest. But if you look and dive in deeper at the unit economics of the business, you oftentimes find scenarios where not only are you okay with them losing money, you actually want them to spend even more money and to lose even more money because you start taking into consideration the lifetime value of these customers. So in this case, basic unit economics, if I just sell one unit for $100 and my cost of goods sold is $25, then I have a gross profit of $50. But I also need to take into consideration what it costs me to acquire that customer. And in this case, if it costs me $20 to acquire the customer, I'm only left with $30 of contribution margin, which is important because sometimes you look at like consumer products businesses and they're like, oh yeah, we have really high gross margins. But when you look at how much they're spending to acquire a customer, they're still losing money on every single sale. And it's hard to scale and be successful in that type of business. In enterprise software, that's usually not the case because you don't just buy the product once. You're on a subscription. You're buying it every year. You're buying access to it every year. I mean, you think about Office 365, which I bet a lot of you use. You buy it as a student, but you're going to have to pay up for it every year. You want to keep using it, right? You keep coming back. And so that brings us to this idea of lifetime value. So if you keep coming back and buying, then it's not $100 of revenue from selling it once, but maybe that customer stays with you for 10 years. So really their lifetime value is $1,000. And in that case, you can spend a lot more money. So rather than spending just $50 to acquire that customer, you could spend maybe $300 to acquire the customer. What that means though, in year one, if you only make $100 off of them, you're going to lose $200 right out of the gate to acquire them as a customer. And so you could look at it and say, well, wow, like you just lost $200 on that customer because they only generated $100 in revenue for you. But if you look at it from this perspective of like, no, I'm investing in the long run in this customer because they're worth $1,000 to me over their lifetime, I'm going to make 3.3 times that my cost to acquire. That's worth it to me, right? And then you can take out cost of goods sold, and that leaves you with a contribution margin of 50%. So even in that scenario, though, you're getting it's going to cost you $200 over the life of that customer plus another $300 to acquire them, still going to leave you with $500. That's still a total cost to acquire plus a contribution margin basis relative to LTV of 2x. And so you may still be willing to continue to invest in that company or in marketing dollars to acquire more companies like that one, because you're effectively doubling your money from a profit perspective. Another thing to keep in mind is this idea of a payback period. So how long does it take to get paid back your CAC? In this scenario, I've outlined 3 years. I'll tell you 3 years is like forever. It's super long. You want to be shooting for a year or less, or on kind of the outside, like a couple of years. But it really just kind of depends on how sticky the customer is too. Because like maybe you don't anticipate holding the customer for 10 years. Maybe you plan on 20 years, right? Much longer lifetime value. Or it could be that 10 years is too aggressive and really they're probably only going to stick around for 5 years. So really understanding like how long customers will stick around with you is important to understanding whether or not it makes sense to invest more money into sales and marketing to acquire more customers or not. All right, any questions on basic financials or unit economics? All right, moving right along then. So the next thing that's worth understanding is the key drivers of your model. You're going to need to forecast out revenue over time. And it's not uncommon for the companies you're looking at to not even have a whole lot of money in revenue. And so you really need to understand the business model. What are the drivers of revenue? Which for a lot of businesses is going to be sales and marketing spend, but like I said, it varies. So understand what's the driver for your business, and then forecasting out over time what that looks like. Knowing that over time, like marketing and sales efficiency is going to go down, right? That same dollar I spent on marketing is not going to yield as many dollars in revenue as I grow and get bigger, because I'm going to use up all the obvious marketing and sales tactics and channels and resources. And so things just kind of steadily get more expensive. Another thing to think about is like, as you're figuring out the levers that you can pull on your model, are you focused on getting more customers? Are you focused on getting customers to buy more, or both? So oftentimes what happens, especially with enterprise software businesses, is that they land and they do what's called land and expand strategy. So they'll sell into one group. That group will have a really great experience. They'll love it. And they'll go to another group at that same company and say, hey, check out this really cool product, right? And they're able to grow within that same customer by selling to multiple groups and drive revenue that way. Another way that it could be done is if you think about like companies like Apple. Yeah, they want to get more people to come into their ecosystem and buy their product, but they also want you to buy more things from them if you already are an Apple customer. So maybe you start out with an iPhone, you like that so much, you end up getting a MacBook, you like that so much, you end up getting an Apple Watch, you like that so much that you end up getting an Apple TV, right? And then like, oh, lo and behold, by that time, your phone is like old and like not cool anymore. So you got to go buy a new phone, right? And not only are you buying a new phone, but by the way, prices have gone up on those phones because they got new features and so on and so forth. So you end up spending more and more and more with Apple. They're able to capture more of your wallet. So there are some of these different levers and understanding the business and like where they're going to focus efforts. Are they trying to sell to more customers? Are they trying to get customers to buy more? Are they doing some sort of blend of both? And then the important thing is be able to defend your forecast, right? Don't just like throw up numbers. Like sometimes we see entrepreneurs and they just like throw some numbers up there, but there isn't like really good defense for those numbers. They're like, oh, well, we think, over time, like our costs of goods sold will go down. And so our gross margin is going to go up. But then they don't take into consideration that they may face like additional pricing power as they get bigger and sell more of these products, right? Or they just are assuming that it'll get better with economies of scale, but they actually haven't done the work to understand whether or not those economies of scale will actually really happen and to what extent. So, and it goes the same for you, like whatever your underlying assumptions are that are driving your forecast, you need to be able to understand them, and they need to make sense. All right, so let's say you've done all of your diligence. You've analyzed the market and the competition and the management team, and you've dove through the financials, and you've got your financial forecast and everything else. And the company's doing great. It's still not enough. You still need to be able to get your money back. And so, and particularly in venture capital, it's really important, because as a venture capitalist, as we've talked in the past, your fund only lasts for 10 years. You're taking money from investors, you're investing it in companies, and eventually you got to get that money back so you can give it back to your investors, hopefully with a return. And so you need some sort of liquidity event. Now, ideally, you end up with a merger and acquisition. Somebody comes in and buys the company, or you take the company public on a public exchange that gives you liquidity and the ability to sell your shares to other individuals. And in that case, it's still an acquisition. They're just buying your individual shares instead of buying the whole company outright. And the last is bankruptcy, which, you really hope is not the liquidity event, because, you basically lose money in that case. As you're preparing for this competition, the way I look at it is you should answer these two questions. One is, if you think the company is going to get acquired, well, actually, the first question to ask is, do you believe that this company can get to $100 million plus in revenue and still be growing at 30 to 40% year over year if they achieve that? If they can get to 100 million in revenue with 20 to 40% year over year growth, then they are a very viable IPO candidate and they could go public. And that could be your argument for the deal. On the other hand, if it's not likely that they can get to that level of revenue, but they could get to like 50 million or 60 million revenue, they can still be a great acquisition target for other companies to buy them. And so in that case, if you don't feel a high degree of confidence that they can get to 100 million revenue, then you may say, I think they're going to get acquired. Just be able to identify who would acquire them and why they would acquire them. So, I've got some of our portfolio companies from Fund 1 here. I like ClassPass because they actually ended up getting acquired. What ClassPass does that you don't know is they have this subscription where you can, for a monthly subscription, and then get access to a whole bunch of different fitness studios. So which allows you to go do yoga one day, do spin on another day, do bar on another day, et cetera, et cetera. And so for ClassPass, right, they're working with all these fitness studios and signing up all these people. Could they get to 100 million in revenue? Yeah, I think there is a case they could get to 100 million revenue, in which case IPO might be on the table. And you'd want to justify that and say, well, ClassPass is growing really fast. They've got nationwide coverage. They've got millions of users, right? We think they've got a lot of potential to continue to growing. It's a huge market. There's plenty of valid support for them getting to $100 million valuation. On the other hand, ClassPass works very closely with a company called MindBody, because MindBody owns the schedules at all of these fitness studios. And ClassPass integrates with them to identify which classes have availability so that their users can go in and reserve a spot in those classes. So in that case, it would also make a lot of sense for MindBody to come in and acquire ClassPass because there's so much overlap. And in fact, that is exactly what they did a couple of years ago. Was MindBody came in and bought ClassPass and rolled them into the business. So in that case, you know, it's helpful to understand who would acquire them and why they would acquire them. And then looking at other similar transactions and how much they were sold for or acquired for. Which brings us to comparables analysis. Now, comparables analysis is used to help us identify the valuation of companies. And the reason why it's so helpful is because valuation is super hard to get right. There are so many factors that come into play. There are external factors, there are internal factors, there are you could have a company that's just absolutely crushing it one day, and then a new policy is enacted by the government, and it basically shuts the business down overnight. So, or it could be also the case where, you just hit the market at exactly the right time, and now you're selling Beanie Babies, and they're going crazy. And you're making a ton of money, but that doesn't necessarily mean it's going to continue. And you just don't know when Beanie's Babies are going to fall out of favor. And so it makes valuation really hard. So oftentimes what we'll do is we'll use comparables analysis, and comparables analysis basically allows you to leverage the expertise and actions of thousands, if not millions, of other investors who are evaluating that company or similar companies. The way comparables analysis works is you're basically going to say, okay, if a company is doing 100 million in revenue and they got acquired for $1 billion, then that means that the investor or the acquirer was valuing that company at 10 times revenue. And if your company operates in a similar place or similar space, doing some, selling to a similar customer, et cetera, then you can take that same ratio of 10x enterprise value or acquisition value to revenue and apply it to your company. So your company is doing 50 million in revenue, and use a 10x multiplier, then the company could be worth 500 million, for example. So that's how comparables analysis works. When you go out to pick companies that you think are comparable to yours, think about it like a house. Houses get valued on number of beds, number of baths, location, finishes, garages, HVAC systems, other amenities, school districts, safety, color, maintenance, market timing, etc. Right? It's the same with businesses, but rather than beds and baths, it could be like market demographics and countries that they sell to, and size of the company and scale of the company and gross margins and on and on and on, and business model. And so your job is to find companies that operate in a similar market, have a similar business model, right, that really line up and do as many things as similar as possible, because that will give you the best comparable for your company. If your company does enterprise software for like law firms, then go look at other companies that do legal software for law firms and how they're being valued. Are they being valued at 10 times revenue? Are they being valued at 3 times revenue? Like, what is it? And you can take that same ratio and apply it to your company in terms of not only the valuation that you're paying today, but also the valuation at which you believe this company could get acquired over time as they grow and scale. All right, so this is a table that we put together for one of our investments in a company called Quantenna. I like this table because it highlights some companies that are very much niche players, but are great comps for Quantenna. So Quantenna, for those of you who don't know, which is probably everybody, it's one of our portfolio companies. They made high-performance Wi-Fi chips. So if you went to buy a router at Best Buy and you wanted the very best, latest, greatest, fastest chipset, it was probably designed and made by Quantenna. So what we did then is we went and looked at all of these other companies that also made chips for different applications. And ideally ones that were like high performing class leaders, et cetera, and identified these different companies. What's great is that if you look down below, these companies all fall in a fairly narrow band for valuation. So it's anywhere between 5.65x and 8.8x. I'll tell you, that's a pretty tight spread. So it gives you confidence that your business is probably going to end up getting acquired for somewhere between 6.5 and 7x EV to revenue, or enterprise value, or acquisition value to revenue. If you got EBITDA, it's great to go to EBITDA and look at your enterprise value, or the value of the business relative to EBITDA spend. I also like looking at things like, what are the gross margins of the business? What are the revenue growth rates? Because oftentimes investors are going to reward, pretty much always investors are going to reward companies for higher growth than companies that aren't growing as quickly. And so you want to look at how these companies are being valued based on their growth. So it's not, if you look at some of these and you look at their growth rate relative to their valuation, you can see that there's some interesting things here. So like Cavium demands an 8.8x enterprise value to revenue, and their growth rate is 22% in the last year. What's interesting is over the last 5 years, it's 29%. So it's come down a little bit, but not that much. You contrast that with like Avago, which grew a lot faster in last year at 69%, than the last 5 years only grew by 35%. So that what that tells you is that maybe this business is really slowing down, right? Or maybe it's really speeding up. Actually, in this case, it would be that the company's really speeding up. Then you have to ask yourself, is the revenues that they are generating today actually sustainable, or is this just kind of a fad for whatever it is they're building? Or is it just like this one product just took off, but you don't know if they're going to be able to replicate that again, right? So anyways, hopefully this is helpful. Things that I like to look at, like what industry are they in? What's their business model? What's their revenue growth look like? What do their gross margins look like? How big are they? How big is the market that they are operating in? All of those things can be interesting factors to help you narrow in on the comps that matter. And I'll tell you, like, one of the big mistakes that a lot of students at UGF make when they first start is they create these like comp tables that are like a zillion companies, but only a handful are actually relevant. I'll tell you, the thing that matters more here with comps is quality over quantity. If all you did was find one comp that was like a perfect comp for your business, that would be fine. And you could value the business entirely off that one comp. Realtors do this all the time. They go and they find this one house that's sold right next to yours, same neighborhood, same shape, same color, same number of beds, baths, etc. You can basically, and sold recently for a similar reason as you, and you can basically just take that same valuation and apply it to your business, or in this case, your house, and know that it's going to be a good valuation. All right. So now we got to like pull it all together, right? From the financials to the exit value. So we've got this spreadsheet. We'll have Rocky send it out if it's helpful to you. It's just a very simple spreadsheet for calculating these numbers. So the first thing is forecasting your financials, right? So you've got your historicals, understanding your historicals, what are the drivers, gross margins, marketing spend, etc. Then using that to forecast out the next few years. In this case, we're assuming that we're going to exit the investment in 3 years. In your case, you may project it out to 5 years or 7 years, or maybe even 10 years. Figure out like what makes the most sense for your business that you're evaluating. Next, we have our comparables. So we do just a very simple table here. We have identified, 4 companies that we think are highly relevant to ours. In this case, this rough deal screen was on Spotify. The financials are totally wrong, but so we went out and we looked at Pandora, we looked at Live Nation, we looked at Netflix. Pandora and Live Nation have very different business models, but they operate in the music industry, which we wanted to capture. And Netflix operates with a very similar business model as Spotify, but in the video space, right? And so in this case, we included those 3 because we wanted to capture a little bit of all 3. And what's interesting here is that the companies that are in the music space have very low multiples and are kind of dragging it down. But the business model that Netflix has is getting highly valued. And so there's an argument to be made to say, well, maybe it should fall somewhere in between, right? They've got the same business model as Netflix, but maybe they operate in a less favorable industry. And so we're going to give them a lower potential exit multiple accordingly. Then you've got on the spreadsheet your investment details. So again, this is the offering. What are you buying? At what valuation? And what kind of ownership do you get for that at the end of the day? And then there's a returns table where we basically say, okay, well, if the company is doing, $14 million in revenue in 2017, and that's when we sell our position, how much are we going to get back? We're going to get back, in this case, this 473,000. If we put in 100,000, well, then that's going to generate a 4.7x. And if I do how much time passed between now and the time we sell our investment, that's going to give and run an IRR calculation. That's going to give us our IRR. IRR simply says how much the investment grows on an annual basis. So if you have a 10% IRR over 5 years, what that means is that your money grew by 10% every year over those 5 years. So 10% the first year, and then the next year you grew, because it compounds, that $110 by another 10%. So now it grew to $121 and then grew by another 20%, and so on and so forth. So that's what an IRR really says, is it's getting at how much your investment is growing on an annual basis. Yeah. And once you kind of pull all those numbers together, then you can start talking about like, hey, we want to make this investment because it can generate a 4.7 to 7.5x or return on our investment, right? We put in $100,000 and we get $753,000 back. That's a pretty compelling investment to get 7.5x, depending on the risks and the other criteria you've already looked at. So in your case, if you're running a seed fund, getting 4 to 7x is great. It's cool, but it's actually probably not enough. You want to be swinging for the fences where you're able to return half to a full time of your fund. And so if you invest $1 million on a $50 million fund, then you have to feel confident that the company you invested in could return 50x, right? Or you might decide, well, I'm going to write a bigger check. I'm going to write a $2 million check out of a $50 million fund. So I only need a 25x, right? And that's where like decisions around how much money to invest in the company and what types of companies you want to invest in come into play. All right. So on your investment thesis, I think wrapping up your presentation with your investment thesis makes a ton of sense. Your investment thesis is like an elevator pitch for the deal. And so you want to hit on these general things. So what does the company do? What's the market size and the trends? Why the company will win? Historical traction and performance, potential returns, and why it fits for your fund strategy, and then the recommended investment amounts. And then after that, I think it's always super beneficial to talk about the major key risks. And this is like a little bit of inside baseball, if you will, for case competitions, broadly speaking. If you want to win a case competition, identify the things that the judges are going to ask you about and be concerned about, like in this case, your key risks, and then immediately address all of those key risks without them having to ask. Because if you can start pulling away their rejections and addressing them really thoughtfully, then they get to the end and they're like, well, I don't really have any objections because you already answered all of them, right? And it puts you in a good position to win. So that's the same case here, right? Look at your key risks and try to mitigate them as much as you can. Now, in some cases, there are risks that just can't be mitigated, and you're going to have to take it on the chin. But you want to be aware of those risks. That doesn't mean that things are bad. Risk is not in of itself bad. You want risk, because without risk, there are no returns. So you're chasing after very risky deals. You just want to understand what risks you're taking and that you're going to be compensated appropriately for the risk that you're taking. Like, I could go run out in the middle of the street and it's going to drastically increase my risk of getting hit by a car, but there is very little reward to doing that. So I may not be, it wouldn't be wise for me to do that, right? On the other hand, if there is a child, like my child, in the middle of the street, I might be willing to run into the middle of the street to save them because the reward of being able to save them outweighs the risks of going out and running into the middle of the street. And those same basic things apply to investing. If you've done your job right and you're evaluating a company, you want risk because that's going to allow you to generate good returns. You just want to make sure that you're being compensated for those returns. Valuations can oftentimes be a key indicator of that. If you pay too much for the business, it makes it really hard to generate the returns necessary to justify the risks that you're taking by investing. So at the end of the day, that's really what this all boils back down to from a due diligence perspective, is ensuring you understand what the risks are and that you feel like you have the potential to get a return that justifies those risks, right? What kind of return would justify putting money into a company that's super, super risky, like a startup? And what venture capital has consistently demonstrated over the years is that certain startups definitely merit the investment, even if they start off as being super risky. An extreme example of that is companies like SpaceX, where the risk is literally that your product blows up on a regular basis before it creates any sort of value, just blows up on the launch pad. But your return is that you basically build a monopoly over space flight and all of the associated rewards related to that, whether it's satellites like the Starlink program that SpaceX runs today and now provides internet all over the world, or it's getting to the moon and mining the moon, or asteroids or whatever for various minerals and resources, right? Where they estimate like an asteroid could have like $1 trillion worth of value in that asteroid. If you can figure out how to get a spaceship, a mining, equipment to that asteroid and mine it for those resources and bring it back to the US, it might actually justify if you can turn $100 million or $1 billion or even $10 billion into $1 trillion, might actually justify those risks, right? So, all right. So just to summarize all the things you need to include in your write-up or your presentation for the business model, you need to hit on what is the pain point, who is the customer, how does the company solve the pain point, what's the business model, how does the company monetize or make money by solving that pain point. For market size, focus on how big is the market, what's the TAM, the SAM, the SOM, and then how quickly is it growing and what is driving that growth? Why are people going out and buying more of those things? Competition, who are the top competitors? We talked a lot about how to identify those. Then how is your company positioned relative to them? Do you have a unique position that convinces customers to buy your product instead of theirs? And what are your company's sources of competitive advantage? So over time, why are they going to keep coming back and buying your product? And what makes it difficult for your competitors to steal that customer away from you? You're going to want to hit on like what the offering. So what is the security you are buying and what are the key terms? Is it a safe? Is it a convertible note? Is it common shares? Is it preferred shares, etc.? For management, who are the key managers? Who are the key owners and founders of the business? Who are the leaders? And why are they the right team to achieve success for this business based on their experience, their expertise, etc.? Looking at the financials, so how has the company performed historically? What are the key drivers of that business? And how can you use those key drivers to forecast out revenues going forward? And we recommend having both a base and an upside case for your forecasted financials. So usually what that is upside case is what the entrepreneurs think is possible, and your base case is what you think rational, like with a more skeptical, rational approach and mindset think is possible. Your exit strategy, how do you anticipate exiting the investment? Is it going to be through an M&A, IPO? And why do you believe that's the case? Are they going to be able to get to 100 million in revenue? Or do they have something that they're building that's super strategic and important to a bunch of other companies that could potentially acquire them? You're going to take all of that and then calculate what range of returns you anticipate based on your base and your upside cases. And then why those returns fit for your $50 million fund and the amount that you're investing out of that fund. And that's it. Those are kind of the pieces. As a reminder, your diligence reports are going to be due November 4th. So that's coming up fast. But you still got a little bit of time to get everything done. Once those are submitted, we will go through them. We will announce the top final teams. We will have 5 finalist teams in Utah, 5 finalist teams in San Diego. We will pair you with mentors at different venture funds that will help you refine your pitch and get you ready. And then presentations will be due on this 15th, and the competitions will be held on the 16th and 17th. So if you are in San Diego, plan on we're going to do the semifinal in person at the University of San Diego on campus on the 16th in the evening. And if you are in Utah, we will be doing it in Utah. Location is TBD, but it will be in Utah in person on the evening of the 17th. The top teams from the semifinals will advance on to the national competition, which will be held virtually December 1st, in which case teams will be competing for the national title between Atlanta, San Diego, and Utah. All right. Any questions? Feel like we covered a lot this evening.
One question real quick.
Yeah.
So on the 4th, we're expected to submit a write-up. Is that correct? Not a deck?
I know that there's a little confusion there. I think you can submit a deck.
Yeah, Peter.
But it needs to have a lot of detail. Go ahead, Rocky.
Yeah, I've just been saying that you're only required to submit a deck.
Great.
With detail, as Peter said. Yeah.
Okay.
Yeah.
Perfect.
Just submit a deck, lots of detail though. And you
Okay.
can throw that detail either in the deck itself or in the notes below. But we will review all of it. We just want to make sure there's enough detail that if you're putting together a presentation where it's mostly focused on presenting things, you may not want to have a ton of detail there, but you also want to demonstrate that you went deep. And so throwing that additional context into the notes can be helpful.
Great. Thank you.
Yep. What other questions do people have? That's a good one.
I had a question about sort of getting financials for companies. So like
Yeah.
we're looking one that's just on a crowdfunding website.
Okay.
And I think they had some sort of like gross margin estimate and then their like current annual revenue. Would
Okay.
you recommend sort of, obviously a lot of that financial info can be sensitive, like what would be the best things to ask for from them that you think they'd be willing to share, or possibly just like the best ways to sort of generate financial projections based off of what they've given online?
Yeah. So every business is a little different. So it's hard for me to answer that specifically without knowing the company. But if they've given you some data points, you can actually ask them in the Q&A of their crowdfunding page some additional questions like, hey, what kind of gross margins are you seeing? What kind of growth rate have you had historically? What are the key drivers of your business? You know, when you spend money, where are you going to spend it to drive more revenue? Are you going to spend on sales and marketing or something else? Right. So you can start asking some of these questions, and as they answer, right, that'll open up additional questions that you might have, right? So they're like, well, yeah, it's sales and marketing. Then you could be like, oh, great. How much, you know, what's that ratio look like? Or what's your customer acquisition cost look like? Or what's your LTV look like? And then use that data to start forecasting numbers going forward.
Okay. Yeah, that's great. They are like a marketing SaaS platform. So yeah, that makes sense.
Yeah. So in that case, if they're a SaaS, like an enterprise SaaS platform or company, then yeah, it's probably going to be driven by sales and marketing spend. And so you could ask them like, hey, what's your CAC look like to acquire revenue? Like, or how much are you spending on, how many dollars do you spend on marketing to acquire, you know, X number of dollars in revenue or what have you? And once you have that ratio, then you start thinking about like, and then you could ask them like, okay, great, you're raising $5 million. How much of that $5 million do you anticipate going to sales and marketing? And if they're like, oh, like 3 million, then you're like, okay, well, for every dollar I spend on marketing, I get $3 of revenue. Great. They're raising 3. That's going to be $9 million of forecasted revenue over the life of that spend, the spend of that $3 million.
Okay. Yeah, that makes a lot of sense. Thanks.
Yep. And look, like none of you are likely to get like full detail down to the line item financials. That's fine. Get what you have, get what you can, and try to make the best kind of educated guesses as possible based on the information you have. That's fine.